Hi everyone, I'm Devon Coombs, CPA, MBA, ex-Google and Deloitte, and today I'm going to be covering technical accounting topics for the foundation of my course, The 10 Laws of Finance. This is a companion resource to my book, and we have a master resource index that has Excel workbooks and practice problems and a ton of other great resources, slides. If you're in one of my courses, this is going to be extremely valuable and essential to succeeding in the course going forward. The study of finance requires that you understand accounting, because accounting really assesses where a business is at a certain point in time, or a person is at a certain point in time from a financial perspective. You can't figure out where you need to go or how to get there until you understand where they are. And the science of measuring a business and where they are financially is accounting. So let's get to it. So what are your three primary financial statements? To understand a company, you need your balance sheet, your income statement, and the statement of cash flows. And these are all used in different ways. Your balance sheet is measured at a point in time. So you'll see on a balance sheet, normally it's measured at the end of a year or a financial year. So you'll see as of December 31st, 2025, for example. And it's going to measure all of your business's assets, which should be equal to its liabilities and equity. And assets are everything that you control, and liabilities and equity are how you fund those assets. If you get something, you can either fund it with debt or you can pay for it yourself. If you paid for it yourself, it would be through equity. If it funded it through debt, they owe money outside, it's funded through liabilities. So you could very quickly see if a business is mostly funded through external liabilities or through its own management. This will tell you a quick picture of its financial health, how able it is to pay any financial debts, and how long it'll survive. The income statement is more about performance. It will tell you top line revenue, how strong a company is bringing in cash, right? That's in the door or bringing in business, and expenses. So that's out the door, how much money they're spending. And then you'll either have income or a loss. And so revenue minus expenses equals income. There's a common misconception amongst a lot of people, even business professionals, that income and revenue are similar. They aren't. Revenue is everything in, income is after you subtract expenses. The last piece is the statement of cash flows. And so this buckets all of the cash flows into three categories: operating activities, investing activities, and financing activities. So you can understand really the story of your dollar. Are you generating cash through your business? Are you generating it because you are taking on loans? Or are you losing cash because you're investing in the business? It's also important to remember there's accrual-based financial statements, cash-based financial statements, government-prepared financial statements, non-for-profit financial statements. There's different ways to prepare these financial statements. I won't go into them here, but understanding how the financial statement is prepared is essential to understanding the story of the business. So if there's a GAAP, generally accepted accounting principles, financial statement that's been audited, which is required for public companies in the US, you will be able to understand that story very differently than if it's a private company's financial statements prepared on a cash basis. So let's start with the balance sheet. The balance sheet really is a snapshot in a point of time. It's a blueprint of your financial position, showing exactly where you stand. So assets are everything you have, liabilities are everything you owe, and equity is what you own. Everything's measured in dollars. It's measured at a specific point in time, and assets are generally recorded at their original historical cost. So if I buy a car for $10,000, I'm not going to write down that car immediately. We're going to have depreciation that's going to slowly deteriorate against that car or be written against that car, but it's going to be measured and have historical cost associated with it on the books, so we can understand the truth of what someone paid for that asset. So let's look at an example transaction, so you can also practice these through the workbook. If you're buying a car, you purchase a car for $30,000, you're getting a new Camry, and you paid for that with $10,000 from savings and another $20,000 with an auto loan. What would this look like from a financial statement perspective? You would have $30,000 in assets, $20,000 of that being liabilities, and $10,000 in equity. So every financial decision you make when you're buying something that retains value, an asset, will be funded with a component of liabilities and equity. And so it will always equal. So from personal finance, you hear this all the time. What's your net worth? This is just a recalculation of what your assets are. So a way to look at this is your net worth is your assets minus your liabilities. From a balance sheet perspective, that's the same as your assets are equal to liabilities plus equity. So you can see how this is rearranged. And then that net worth is really just a measurement of your assets, which is telling you what you truly own. And so if you have one friend who has $1 million assets, they own $1 million from a home and a car, but they also have $1 million in liabilities, that's a much less wealthy friend than a friend who has $1 million in assets and $1 million in equity, right? They fully funded it themselves. That the person who has $1 million of assets that's fully funded by liabilities is at much higher risk. The same is true for businesses. They both have control of those assets, but one person actually owns them. The other person has a debtor outside owning them. It's important to understand just some common classifications of these different categories, assets, liabilities, and equities, just so you can really understand finances. I'd recommend looking at the businesses you're assessing on their balance sheet. You'll be able to see what they're classifying. But here's some of the most common. You have cash, which is money that you have access to immediately. Then you have land or property that you own. You also generally see plant, property, and equipment. These are long-term physical assets. And then you have intangible assets like trademarks or goodwill through acquisitions or capitalized software. Liabilities tend to be credit card debt, long-term loans, mortgages. You can see anything where you owe money to an external party. Equity is what you own. You generally will see common stock value, and then you'll see things like retained earnings. Retained earnings is the accumulation of net income over time. And so just make sure you understand all of these different areas and where they would be categorized. Like balance sheet, you take a picture at a point in time. The income statement is a movie. It's something you watch over time. It shows you a business's ability to generate surplus or have a loss over a period of time. So you take a start date, let's say January 1st, and if you're measuring a month, the end date is January 31st, and you'll look at all the revenue and expenses and summarize it into revenue minus expenses equals net income. So this tracks performance, not cash specifically. Revenue is going to be recognized as it's earned, as a performance obligation is satisfied, and expenses are going to match the pattern of revenue recognition. That's the goal of GAAP accounting. So I don't want you to conflate those concepts too much, but it's important to think of revenue as what comes into the business and expenses of what flows out of the business. So let's use an example here. Imagine you bring $5,000 in this month from your salary and your total spending is $3,800. You can just see here that your net income would be a $1,200 surplus, right? Your revenue minus your expenses is going to equal your surplus. So you're fueling for growth. If your expenses were $6,000, you would have a $1,000 loss. So here's what a multi-step financial statement looks like. You take your revenue, which might be your salary or investment income or your sales or service fees. You're going to subtract out your cost of goods sold, which are your direct costs. So that might be your cost of revenue or your cost of inventory. That's going to equal gross profit. To get to operating income, you then subtract out operating expenses, like your rent, groceries, or utilities from a personal view, or from a business perspective. You're going to have concepts like salaries for your officers, office rent, selling and marketing expenses. That equals your operating income. Then you'll have other expenses like interest expense. And then only after you subtract out the interest expense, or then you get your net income, and then you might subtract out your tax expense to get an income after taxes. So you could see how you could break this out to understand how a business does in these different categories. And the reason this is important is so you can understand if you were to take over that business or you're to manage this business, how you can make the business more profitable, what kind of levers you have. So if the business has strong revenue but is losing money, the issue might be the cost of goods sold are too high, which is a bigger problem for the business, which means we have a pricing issue for the business. Or it might be that we have too much selling expenses, and maybe we need to change the salaries of our sales employees or a commission structure. Or it could be we have a ton of interest expense, which means that we need to restructure the business or manage our debt portfolio. So understanding all of these categories can help us manage the business and drive more success in the business. The cash flow statement really tries to explain the story of your dollars. It starts with your beginning balance of cash from that period measured, and it ends with your ending balance of cash from the period measure, and it breaks it out on how those dollars move from operating categories, financing categories, and investing categories. And so this is integral because there might be some companies that recognize a lot of revenue or have positive income, but have negative cash flow because they are making lots of investments, and that might tell you a story of growth. They also might have negative cash flow because they are spending a bunch of money on refinancing debt or old debt. That's a different story. They might be spending all of their money on operations, which tells you maybe the company has a lot of revenue and income, but they are struggling from an operational view. And then you might want to check their accounting practices. Maybe they're changing their depreciation practices. So this helps you bridge the gap from an accrual basis to a cash basis and understand the story of the dollars and how they're being spent. So let me break down those categories a little further. Your operating activities are your cash and your core day-to-day activities. So this is going to categorize things like your paychecks received, your cash from side work, money spent on groceries, rent or utilities, your regular sales from your business, your cash collections from your business, and everything you spent to support that day-to-day aspect of your business. You're spending on money on your inventory or your employees. Your investing activities, you think of it as your long-term assets, what you're using to buy or sell long-term assets. So personally, that's buying a home or a car, or renovating your house, or purchasing stock. Businesses, this would be investing in new business areas, buying property, plant, and equipment, or buying long-term investments like stock or equity in other companies. Financing activities, you think of as your long-term liabilities. And so that's cash taken on from a debt investment or ways to repay it. So if you took on a mortgage personally, that would be your financing activity to help you finance your home. For business, that's if they issued bonds or took on loans to support their business. You can really think of the operating activities as your short-term assets and liabilities, your investing as your long-term assets, and your financing activities as your long-term liabilities and equity. You can have a positive net income, but a negative net cash flow and vice versa. Cash flow reveals your true financial discipline. If you have a high profit, but negative operating cash flow, you might have a lot of sales on credit. So you have a lot of revenue, but you haven't collected the cash yet. And so then there might be an issue from a cash collection standpoint. But maybe it's not coming from your regular profit margins. It's not coming from your regular sources of income. So maybe that means the business is changing. Income is what you've earned and cash is what you have. You need both, and you need to understand both to understand the story. All of these financial statements are interconnected. You're going to prepare your income statement first so you can get your net income numbers, because those net income or loss numbers flow into your retained earnings in your balance sheet. And once you have that, you can actually prepare your balance sheet. You can't prepare your balance sheet until you've completed your income statement. Your statement of cash flows needs you to prepare your balance sheet because it's going to take your change in cash. It's going to have your ending cash. It's going to tie to your balance sheet. And that difference between your cash on your balance sheet and last year to this year should be your change in cash in your statement of cash flows. So all of this should tie. We call it ticking and tying in accounting, but all of it should tie to make sure that you're telling one cohesive story about your finances and your dollars. So again, balance sheet shows your capacity, your financial capacity, where you are at a point in time. Income statement shows you your performance, how you perform over a period of time. And the cash flow statement shows you your discipline, how you're managing that money. Mastering these views gives you a full understanding and perspective of a company or a person's narrative of their financial journey. So my recommendation for you all here is I have a workbook on the Master Resource Index where you can either practice the case study. I have a case study where you build the financial statements for a business, or you can build your own personal financial statements and it's your own personal budget. I have those two resources available for you live on the Master Resource Index. If you haven't, I'd recommend reading the chapter of the book. And then once you practice this material, you've practiced and watched these videos and you've watched the narrative video, you can start practicing on the workbook to practice problems. And I'll create another video where I'll go over some of those more complex problems just to help you along your way. So thank you very much for watching. If this was helpful to you, please let me know. Put in a comment below if I can change any of this to be more valuable, or please share it with your friends if you think it would be helpful to them. Thank you very much and have a great day. Bye-bye.